to talk to you about the comparison between the self-directed IRA and the 401k. Then I'm going to talk to you a little bit about myself, and then I'm going to give you some precautions where most people make their mistakes. Right? We're going to do this in a short amount of time. Don't expect to learn everything here. All the charts that I'm going to show you on this is on our website, so you don't have to take notes. Just sit back and think about what we're saying and what it really means to you. And then Marc's going to talk about his real life experiences, and then timing and chronology of what we're doing with some case studies. Does that make sense? You get to see what other people are doing and where it is from me. That disclaimer basically up there says, don't trust anything that I say. Ask me any of the questions that you want, but don't trust my answers. Do your own due diligence. But just so you know, I do teach continuing ed to accountants, attorneys, and realtors, and financial planners. So, but I still want everybody to feel comfortable, and don't ever not do your due diligence on who the people are that you're working with, as well as your investments. All right, I was born in Montclair. My mom and dad moved to Florida, Fort Lauderdale, when I was 1 or 2. So I grew up in Fort Lauderdale. It was really tough. Yeah. I went to school at Cornell, graduated in engineering. I went to Kennedy Space Center after graduating and launched rockets for about 18 years. My dad died. I found out about self-directed IRAs. I opened up Camaplan in the Philadelphia area back in 2003 or 4. We started in 2003, had our first client in 2004. And the reason I'm telling you this is because, one, most of my goals are set around my family. I'm the oldest of 12 kids. That's about, the picture on the top there is about half of our family reunion. 150 people show up to it. I see all kinds of walks of life and heard all different stories. That's my mom in the upper corner, and my 2 granddaughters. Okay, and the reason I bring them up is because I set my goals around these people, right, on their education and their health and what they're going to be doing. So, and in the middle there is real estate. I'm biased towards tax-free and real estate. You know, can I do the stock market? No, I can't. I've tried it and I'm not good at it. So when I'm doing this, I'm trying to think, all right, what do my kids need? Right, so there's health savings accounts. If you pay your own health insurance, you should look into those. And if you're looking to pay for kids' educations, you should look into educational savings accounts. Why does self-direction work for people? Anybody know? Who has self-directed IRA? What do you like about it, Chris? Okay, so you get to pick your investment. You have more picks. I like that. Ken, what were you going to say? It's a control aspect. Why do you pick real estate to invest in? A good growth vehicle? What else? How about, is it tangible? Right? Is it something you can see? Anybody ever steal it yet? Right? Anybody buy Wachovia stock back in 2008 or 9? Everybody have it? Before the market crashed, it was 30 bucks on Friday, 10 cents on Monday. I've never seen a house do that. It keeps it simple. If it burns down, the insurance company pays me or my IRA for it, and I think it's great. And it's the only way that I know to get real diversity is through self-direction. So let's kind of go through the 401k versus the IRA. The first one is up there is creditor protection. People always ask, is the IRA or the 401 protected from creditors? How many people think it is? Anybody know O.J. Simpson? You ever hear of him? Right? Remember how he still had his money because it was in a pension plan from the NFL? Right? And they were suing him and they got the suit. It is protected. Is it protected as good as an ERISA 401k? I don't know. It hasn't been tested that well. But the 401k's and the IRAs are pretty well protected from creditors coming in and taking your account. Now, if you have a piece of real estate in it, and either one of them, that can be sued, but your insurance should help you for that aspect of it. Can you have a tax-free IRA and a tax-free 401k? Yeah, right? They added tax-free to the 401k's either in 2008 or 2010. I can't remember that, right? How much can you put in a Roth IRA? Anybody know? $5,500 or $6,500. How much can you put in the Roth 401k? $18,000 or $24,000. So can you see the difference in the amount you can put there? So that's one of the reasons people think there. So if you make $18,000 and you're under 50, you can put that whole amount into your Roth 401k or the traditional side of it, right, and not pay any taxes. So there are advantages to doing these things. Tax deferred accounts available, right? Is the money going in to the Roth 401k tax deferred or the Roth IRA? Do you get a break or not? No, you don't. If it's going into the Roth part, you don't. If it goes into the other, right, in the traditional side, you do get a break and you pay less taxes, right? But remember, what do I like? Tax-free. I want to pay the taxes up front so that everything I take in the when I make it is all mine. So I always think of it like this. If I were a farmer, would I rather pay the tax on the seeds or the crops?
Well, wasn't the original idea back in the 80s or 90s that by deferring the taxes, you're going to pay the tax later when you're technically or theoretically in a lower bracket than you would be now?
Yes, that was the rationale when they started these things out. You'd be paying a lower tax when you got out of the higher tax brackets. But let me tell you what's happening, okay? And you can talk to your accountant, you can look at friends around you. Who's going into a lower tax bracket? Who's gone into a lower tax bracket in the last few years? Are taxes going up, number one? Are the brackets going up? Is the government spending more money? Right? Now, when I had my 4 kids at home, right, and they were eating all the groceries and everything else, and I got to take the deductions for those 4 kids, and my mortgage on my house was really high, I got to take that interest. And even when I was doing that, interest on credit cards was a deduction. I think it's a fallacy to think you're going to be in a lower tax bracket when you retire, because you're either going to be taking money out of a tax deferred account, right? Now maybe the first year or two that you quit working, that might be a year to convert, but you have to look at that and you have to get with your accountant and talk to them about this stuff. What is your plan? What are your goals? What do you think your deductions will be then? I personally have my taxes just keep on going up. They haven't stopped. I just turned 61 and I said, well, when's this retirement stuff supposed to be here? And I'm supposed to be making less. I think that a lot of people should look at their lowest tax bracket when they got their kids in their house and they're just starting out. Just look at it and see. You know, other people say, oh, I want my house paid off. I don't want to owe anybody any bills. And guess what? Now you're in the top tax bracket because you got no write-offs. Checkbook control. Who wants checkbook control of their IRA, right? They don't want to have to come to us and take an extra 48 hours to do a deal, right? Some people sit at the table and buy a piece of property that day. Some people got to go to a tax lien sale and pay for it that day. So can you have checkbook control with an IRA? Yes, you can, but you have to form an LLC. The IRA has to own it. Swanson versus the IRS is the case there. You really should have somebody else do it besides yourself, which becomes another problem just because of all the laws associated with it. Cut the checks for you, right? Because theoretically, they won the case against the IRS, and the IRS had to pay Swanson, but it will be overturned next time it goes because they didn't fight it on the right number of cases, and people are scared. And just so you know, the IRS goes after checkbook LLCs and unsecured notes as their 2 highest categories. And they've just required us to report to them anybody who has checkbook LLCs, trust, promissory notes, etc. There's like 5 or 6 categories, and I got them here later in the presentation. On a 401k, because you're a business owner, the government cut you a little bit of a break, and they say, yes, you can control your 401k, and you can be the custodian of it. And to me, it's way safer than a checkbook LLC. I don't recommend checkbook LLCs. We never have. We have clients that do them, but I never recommend them. Is a custodian or administrator required per Internal Revenue Code 408A, which I just talked about? The answer is no for the 401k, but yes for the SDIRA. Right? And business owners get this break because they pay taxes for people, right? They do the book work, they verify their citizenship. The federal government pushes all their rules and regulations back down to business owners. Administrative fees. Both of them have administrative fees. It's $300 more for a 401k with us than it is for an IRA. You know, that's basically the difference, is $300 and maybe a little bit more reporting for the 401k, if you know, especially if you do your own model. Able to purchase alternative investments. Both of them can purchase the investments that we're talking about. Real estate, there isn't much of a difference from that aspect, except for one that I know of is life insurance. And can they buy life insurance? The IRA, no, you can't. Not yours, not anybody else's. You can't buy life insurance. It's prohibited. With the 401k, you can, but you want to make sure you do it cautiously and conservatively, and talk to your accountant before you do that. Self-employment is required, right? You have to have a business to have a 401k or a solo 401k. Can it be a proprietorship, a single proprietorship? Yes, right? But you have to do the business tax form when you're done. Can it be a partnership? Yes, it can, even though it's a solo, as long as the partners are the only people in the business. You can't have it. You can't have a solo 401k if you've got employees. Right? Once you have employees, then you have ERISA laws that kick in, and you have to do a lot more testing.
Can you go back about what you said about the partnership? I mean, partnership is not a solo.
It's not a solo, but if you're owners, then you can be in the same plan as long as you don't have employees. You can have more than one person be an owner of a business.
And you can have more than one person be in a self-directed 401k.
Right. If they're the business owners, you can have, let's say you got two other partners. Now each one of those people will have a section in that solo 401k plan. They can each contribute themselves or they contribute together, but if they contribute together, then they have to maintain that percentage. All right, can you take a personal loan from an IRA or a 401k? Can you take one from an IRA? The answer is no. Can you take one from a 401k? Yes, you can. Everything I'm talking about is on our website on the solo 401k page. So you don't have to worry about too much notes. The answer is, on a 401k, you can take a loan. You can take up to $50,000 or 50% of what your account is worth, whatever is less. So that's an advantage some people like. I don't recommend that because I think you pay double taxes when you take loans. So I don't recommend that part of it, because you pay taxes on the money when you pay it back. You don't get a deduction for paying it back, and then when you pull it out to use it next time, you pay taxes on it at that point in time on the traditional side. Fair market value reporting to the IRS. The IRS is getting more and more stringent. They want to know how much people have in their IRAs, so we're going to do fair market values. On a 401k, you report those fair market values most of the time on your 5500, which is the 1040 for the 401k. If you have a Roth IRA, does anybody know when you can take money out of a Roth IRA without being taxed on it? 59 and a half. Anybody else have a guess?
After owning it for 5 years.
After owning it for 5 years. Good answers, and they're all right in the IRS. But guess what? If you have a Roth IRA, right, you can take your contributions out of that the next day, the next week, the next year, the next 10 years. It doesn't matter. You can take your contributions out anytime you want. You can't do that with the Roth 401k, okay? Because when you take distributions from the 401k, you have to mix them with your pre-tax and your post-tax. That's a little bit different on the RMDs. Now, what do you think I'm leading up to? I think you should have both, you know, if you can afford it, right? I think you should have as many of these plans as you can so that you have the capabilities to meet your goal, which was what? Have as much passive income tax-free as possible. How do you report distributions to the IRS? 1099-Rs, right, and 5500, you can use that for the 401k. If you have your own 401k, you have to do that yourself if you're there, or you have to have your accountant do it for you if you're going to have them do the books. We don't do that, and there could be an additional cost for that part of it. If it's in the IRA and you do it, we will do that, and it's done on the 1099-R, and we do cover that from an IRA standpoint. Federal tax withholding on distributions. If you take a distribution from your IRA, you can actually say to us, don't take any tax out, or take 20% or 10 or 30, whatever you think is fair or what you want. On a 401k, most of the time it's mandatory that they send 20% of your distribution to the feds. So there's another little difference that's there, and then you have to fill out your return to get that money back. Prohibited transaction rules apply. Yes, they do for both of those. Unrelated business taxable income rules apply. But let's say I wanted to buy a Rita's Ice with my 401k. Now I go and I buy that. Now I'm running a business out of my 401k. That now can't be all tax-free. You have to pay what they call unrelated business tax for that. And that is at trust rates at 40% pretty quick. I think if you make more than $15,000, you're at 40%. It's active, yes, that's exactly right, because it's an operating business and not an investment.
Do contributions need to be made by year end, or do you have with 401k, or do you have until April 15th, like the IRA?
401ks, the salary deferral has to be done by 12/31, but everything else can be done all the way up till the filing for the business plus extensions. And that's on our website too. And that's the same. Your accountants or who's ever doing it can answer all that. Because just because it's self-directed doesn't make, the rules don't change, right? I mean, let's say you're a fireman by night and a chemist during the day, right? Can you have two, right? And both companies give you a 401k. Combined, I think you can only get $55,000 into two of them, however you come up with that. And you'd probably pick the one that matched you the most. Unrelated debt financed, right? If you're borrowing money, this is kind of a big one. If you're borrowing money to do real estate and leveraging your real estate, in an IRA, most of the time you're going to pay that tax on that portion of the money that you borrowed, or whatever that prorated share is, unless it's Section 8 housing or government housing of some sort. If you do it in your 401k, for some reason they said, hey, you don't have to. If your 401k borrows money for an investment for real estate, you don't have to pay unrelated debt financed income. So if you're planning on borrowing money and leveraging it, then I would definitely look into these 401ks, because, again, that's at 40% of how much you make. Contribution limits, Mark is going to cover those, or ask your accountant for both of them. We touched on them a little bit. Tax on early post-tax contributions and distributions. That's what I already talked about, right? With the Roth IRA, you can take the money out anytime. On the Roth 401k, if you have 50% pre-tax and 50% post-tax, then when you pull a distribution, you have to pull from both of them equally. Okay, if it's 60-40, then you're going to have to pull 60-40. So you'll never really get a tax-free distribution when you have a 401k that's got pre and post-tax money into it. Here's some precautions. People say, well, I'm just going to have a solo 401k. I got my 15 employees over here, but I don't want to screw around with them. I'm just going to open up this other investment company and have my own 401k with myself and my wife. If you have another business that you own, you can't do that. Your businesses have to be the same across the board. So that's what they call control groups. If you own one business and you want to have a 401k for it, then all your businesses have to have a 401k. Business formation. You have to form that business to have a solo 401k. You don't have to have it for a 401k, for an IRA, right? You can work and have earned income and put it in there and not have to have any LLCs, et cetera, if you just want to have an IRA. If you have employees, right, or you plan on having employees, you can't have a solo 401k. Don't start out with it. It's too hard to switch it back. I shouldn't say too hard, but it's costly and expensive to try to put it back in with the employees. Because once you bring employees into it, you got the ERISA laws, the attorneys, you got testing, you got third-party administrators, and people complaining. Continued contributions. Here's another one that a lot of people don't understand. When you have a self-directed IRA, checkbook LLC, people think they can keep contributing to it. But by the letter of the law, you can't, okay? Because the first time you form this LLC with this custodian or this manager of the LLC, he's not a fiduciary. But once you give him that money, he becomes a fiduciary and becomes a disqualified person. This is a little esoteric law that's out there, but you need to be aware of it, because if you think each year you're going to make contributions and continue to put them into the checkbook IRA, that very well is a prohibited transaction. Is the IRS doing anything with it right now? No. Do I know thousands of people that get away with it? Yes. But I'm just telling you these things up front so that you understand them. IRS has new reporting. Last year it was volunteer, this year it's mandatory, right? They're asking about 5498s, which is what is your account worth, the fair market value, and they're telling us, tell us when these people have an IRA that's invested in an LLC, real estate, limited partnership, unsecured note, but all those things are now on us to go report to the IRS. How good are their systems? It's the same people that built the Obamacare website, but sooner or later they'll get it right. So they're going to be able to go in there and they're going to be able to target people that have checkbook LLCs, which I think is already one that's up there. So if you have it, how many people in here have checkbook LLCs? Good. I'm not going to spend too much time on it there, but if you know anybody that does it, now's the time to make sure you got all those things in order. The other one is size and visibility. What's the size of your 401k? You know, how visible is it to the government? How good are you, right? That's what I want people to kind of think about, right? When Mitt Romney's $100 million IRA came out in the newspapers when he was running for president, that caught a lot of people's, how did they get that, right? And of course everybody said, oh, it was a self-directed IRA and he invested in yada, 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 right? And everybody's calling me up saying, I want one of those Mitt Romney IRAs, right? So, I mean, it was good for us from that aspect, but then when they figured out they had to choose what their investments were, it became a little tougher. So you kind of just want to understand where those things are. With IRAs, you can split them. You can have multiple ones. With the 401k, you know, a lot of times you'll put a lot of properties into it. As an example, if one of them gets sued, you know, how much are the other ones that are there? Ryan is my son. He works for me. Everybody know Ryan in here? But call the office, talk to Ryan if you have any of these questions. At this point, I'm going to give it to Mark to come up, and he's going to tell you actually how it is. How many people are going to convert to a Roth? You have already? Okay. You guys are going to convert? All right. This book right here, Keep It, by Joe Luby, it's like 20 bucks. Very well worth the read, okay? Saved me tens of thousands of dollars. No kidding, right? Very, very smart. I didn't do it in '98, but I did do it whenever the last election was, and it was very helpful. Keep It by Joe Luby.
Carl, thank you very much for that. It's more than just an introduction, actually, you know, to describe the advantages and disadvantages of 401k's versus IRAs in the self-directed area. And what I'm going to do now is I'm going to tell you what I've actually been doing and why I've been doing it, and I might even get a little bit into the goals that I've had with this. So again, I'm Marc Halpern. We just launched PartTimeInvestors.com a little while ago, a couple of weeks ago. I do have my self-directed 401k with Camaplan. I do not work for Camaplan. I don't get any breaks from Camaplan, except for the fact that Carl Fisher is the best, most knowledgeable person on the face of the earth. So I'm going to show you a little bit about what I've been doing with my 401k. But first, I need to say, while I am a successful part-time real estate investor, I am not an attorney, I'm not a licensed financial advisor, I'm not an accountant or any of those sorts of things. So please do not take any action at all based on whole or in part in anything on the content of this presentation. And you really need to speak with a licensed professional in your state before you make any sort of investments. I also need to disclose that I am a licensed New Jersey real estate salesperson. Not necessarily proud of it, but I have to disclose that. Why did I choose a self-directed 401k instead of a self-directed IRA? And the answer, and there's all kinds of advantages and disadvantages like Carl spoke about, but the major reason is because I want to turbocharge my Roth, whatever it was, my Roth retirement plan. And because the contribution limits, that's what I was able to do that. I really had virtually no Roth. I had some Roth IRA. Actually, I still do. I have to actually roll it over. A couple of $1,000s from sometime in the 90s, but I never really did anything with it because it wasn't enough. And if you want to invest in real estate, you really need a substantial amount of money, and I really wanted to get to that point. Oh, by the way, I need to maybe first disclose I'm a chemist. My primary occupation is in chemistry. I've written 4 books in organic chemistry. And one on real estate investing, but my primary occupation is definitely in the chemical field. So this is, and the company that I have my 401k with is a chemical consulting company, which has been around for a while and doing quite well. Okay, so I was looking for basically the Roth 401k and the contribution limits. Now these are the numbers, and I started this in 2007. I was 53 years old. So here's some of the contribution limits from 2007 up to 2016, and there are several parts to it. The first part is how much you can contribute. Just like Carl mentioned before, with an IRA, you can contribute $5,500 a year, or $6,500 if you're over 50. I was 53 when I started this. And if you want to get a critical mass of money so that you can get to the point where you can invest in real estate, how long is it going to take you at $5,500 a year to get to the point where you can even buy real estate? Here in South Jersey, if you have about $100,000, you can do all kinds of really good things. And it would just take forever. And I was 53 when I started this. There was no way I was going to get to where I needed to be if I was going to do it with an IRA. With the self-directed 401k, my elective deferral limit was $15,500 plus, this is back in 2007, plus another, was it $5,000 because I was over age 50. So I could contribute $20,500 in my first year, and that's indeed what I did. I contributed the max. There's all kinds of profit sharing things that you can do, and back in 2007 you can contribute up to, was it $45,000? Plus another $5,000 for being over. Basically, you can contribute up to $50,000. Today, you can contribute up to $59,000 total, of which, let's see what the numbers come out to be. At my age, I can contribute, I guess, $24,000, and then the company can contribute more on top of that with profit sharing up to 25% of profits for a total of $59,000. And that's going to change in the future. These numbers change all the time. That includes a profit sharing. Anyway, those numbers, again, you can look these numbers up. You can Google them and get all these numbers. But clearly, today, if I can contribute $24,000 into a Roth, up to $24,000, if I have a business where I can contribute that, that is a lot more than $6,500. So you can really ramp up really quickly. And if you're in your early 50s, remember when you're 59 and a half, you can, if you need to, you can really start taking these monies out in the right proportions relative to the other 401k. So I really started contributing into my Roth 401k, into my 401k, but mostly in my Roth. I was really focused on the Roth because, just like Carl said, there is no more magical money than Roth money. It's tax-free forever. For those of you who watch public television, there's a guy by the name of Ed Slott, and whenever they're trying to raise money, they always put Ed Slott's material up there, and he's always talking about, he says, change from forever tax to never tax. Anybody hear that on TV? Going from forever tax to never tax. And he talks about there are two ways to go from forever tax to never tax. And one of those is the Roth IRAs, Roth 401k's, and the other are certain types of insurance. Now, what's nice about Ed is that he doesn't sell insurance. He's an accountant, and his material is pretty good. So I do recommend the next time you're listening to public television and you're looking to make your contribution, I think it's $150, you get all the CDs. That's pretty good. Or you can just ask Carl Fisher, Camaplan, about these things, and you can really get a really good information about the Roth 401k. But I really wanted, my major goal was to turbocharge my Roth, and the way to do that was my Roth 401k. So I'm going to show you something which I was debating whether or not I should go public with this. I'm showing you just my Roth 401k. I'm not showing you my traditional IRA material, and I'm not showing you my regular 401k. But I just want to show you how fast I was able to ramp up my Roth 401k numbers. In 2006, I didn't have it yet. I started in October of 2007, and now I'm just about $200,000 of tax-free money. I pretty much paid tax on roughly the first $50,000. Just like Carl said, I paid taxes on the seed, and now the crop is tax-free. And then you can see the rate of growth that I had. There was a year, I think it was 2011. I'm not sure if I have to go back and take a look. I did not have a good year, and I only contributed $793 that year, and I was not very active. Some other things were happening, and I didn't do any investments in that year. So that year was pretty flat. But other than that, it's been really going very, very fast, and this is very good. And the way that I grew this, of course, contributions was important. Well, actually, it's less important now, but it certainly was much more important in the beginning to get ramped up. I did some private lending. I try not to do that anymore for a whole lot of reasons that I won't go into in this particular presentation, but some of you have heard some of my other presentations might know why. And of course, real estate investing. And real estate investing is the major reason why I really want to turbocharge my Roth. I have real estate investing in my 401k as well, not the pre-tax portion, and I'll show a little bit about that soon. And by the way, just for funsies, I decided to say, if I did not, if I had a Roth IRA instead of a Roth 401k, then this is the growth rate that I would have expected, because I could only have contributed up to $6,500 every year, and in those years where I did not have a good business, I didn't have enough money to contribute, I sort of factored that in as well. So as you can see, it's certainly well over $100,000 more. Here we are 8 years after I started my 401k, my Roth 401k, and I have more than $100,000 extra in my Roth 401k than I would have had if I opened a Roth IRA. It's very interesting when there are many times in life where you make a decision, or you don't make a decision. Actually, more often than not, it's lack of a decision, where there's a fork in the road, and sometimes you're aware that there's a fork, and sometimes you're not aware. At these really crucial moments in life, it's very, very important to make crucial strategic decisions. And in October of 2007, I knew about self-directed IRAs and self-directed 401k's, and I decided I'm going the 401k route, and I actually thought about it. I read up about it. It turns out, I'm semi-literate. The IRS code's written in English. It's a good match. And I was able to read. My reading comprehension skills are consistent with Common Core standards, so I was able to read this stuff and realize that the Roth 401k, the 401k would be the better way to go. Again, I have a business. It was a chemical consulting business. I have a business that enabled me to do this. If you don't have a business, well, you can start a business. People say, well, I don't have a business. Okay, well, start one. Can't be a hobby, has to be a real business. You'd be surprised how many different kind of businesses you could start that are real. Okay, so let's take a look, and I'm not going to show all the different properties that I've done, but I want to show a few selected ones. And some of the people here I know have seen some of these properties on the inside and while it was being done as well. So this is a property that was in Woodbury, New Jersey, and my intent was to have this as a rental. Woodbury's got a lot of rentals. This was going to be a rental. This was on Railroad Avenue. It was actually right in front of the railroad tracks with no fence, about 70 feet from the front door to the railroad tracks, which is an amazing thing. And but it was a HUD home, and there's nothing easier to buy than buying a HUD home. I've bought 5 HUD homes until now, between myself and between myself, my LLC, and my self-directed 401k. I bought 5 HUD homes altogether. The purchase price on this was $60,000. I knew that the fair market value was at somewhere in the 130s, maybe even 140, but I knew it was going to be certainly in the 130s. I bought it for $60,000. The rehab cost was, I actually went back and looked at all my numbers today, the exact numbers, and it was $32,046, and my buying and holding costs were $56.59. So the total amount of money, of cash that I had in the property was about 97, let's say $98,000. Okay, so I had about $98,000. By this time, I think I had $101,000 or $102,000 in my Roth 401k. So I was able to buy this and fix it outright, and I was going to have it as a rental. It wasn't, not that it's really relevant, but the ARV, the after repair value, was somewhere in the 130s, so I had instant equity somewhere in the $30,000+ range, but it didn't matter. The intention was to have it as a rental. It's important to have a very good strategy that is likely to be compliant with IRS guidelines sometime in the future. It's a 3-bedroom, 1.5 bath. It's 1,740 square feet. It was a HUD home. It was a really nice property. By the way, if you're interested in learning more about how to choose houses for rentals, you can. It's not on right now, but it'll be up in the next couple of weeks on PartTimeInvestors.com. One of the videos that I have is called "How to Choose Houses for Rentals." It's pretty good. It's about an hour and a half presentation. Found a tenant candidate, filled out his application. And lo and behold, we find out that his credit score is nowhere near as bad as he thought. So the total costs were about $98,000, and because it was free and clear, there's no mortgage on it. The positive cash flow is going to be the rent minus the taxes and insurance. Taxes in Woodbury are extremely high for a $135,000 house, $463 a month. Woodbury is one of the highest taxes around, but the reason why I thought this was feasible is because I got it at a really good price. The insurance would have been $90 a month. So with a rent per month of $1,495 a month, positive cash flow would be $942 a month, and my cash-on-cash return would have been 11.6%. Now, you can get those kind of numbers maybe not these days with private lending. 11.6% is an okay number for me. Some people say, oh, 11.6% is a great number, especially considering that the underlying asset, its value, it's not going to crash like a stock would. It's almost like a dividend. Imagine a dividend paying stock that doesn't go down, and the dividends are 11.6%. I mean, most people would kill these days for a 3% or 4% dividend. The way to look on cash return is the kind of dividend that you're getting. So 11.6% is pretty good. The tenant candidate was looking at these numbers, and it was funny because today I actually found the lease that I gave them for review that we were going to sign the next day, and he comes to me and he says, you know what, I asked around and I found out that I could own this house for less than $1,495 a month. So he said, would you sell me the house? And I said, well, for the right price I would. And he said, well, how much? So I said, I pulled a number out of an orifice typically covered by cloth, and I said $138,000. So he said, $138,000, how about the $138,000, and he gave me $3,000 back at closing. Sure. So we signed the deal, and again, as the self-directed, we'll talk about this in a minute, as a self-directed 401k, I can't do any work, and we'll talk about in a minute how I didn't do any work on this. But I can sign agreements. We signed an agreement of sale for $138,000 minus the $3,000 of seller concessions. And the selling costs were very low. It was just a realty transfer tax and a deed. That was it, because there were no realtors involved. There was nothing involved. I didn't do any marketing myself. I didn't do anything. The tenant said he wants to own the property. So in the end, I wound up making over $36,000. Now this is really interesting. I made $36,000 in my self-directed Roth 401k. What are the tax ramifications of that? Zero. Don't pay anything. So it's tax-free forever, or tax never, I guess, as that slot would call it. So this was a really good. This was a very good deal for me. Now I intended to have it as a rental. A little bit later, I'll talk about what I like to do with rentals, and maybe just a preface. I like to have my rentals in my self-directed 401k and Roth 401k generate about $1,000 a month of positive cash flow when they're free and clear. Again, the yields are only about 10 or 11% usually, but for me that's okay, because I'm looking. I will talk about that again later. I'm looking also for time on cash return, not just cash on cash return. We'll talk about that philosophy in a few minutes. So I made $36,000 in my Roth, and that in the graph that you saw. So there's a picture of the house, and the big spike. The big spike that we see in 2014 was this $36,500. Now, if I would have been building my if I would have had a Roth IRA and have been building it really slowly, then I probably wouldn't have been able to have done this deal, because I didn't have a Roth. I could have done it in my 401k, because I have a self-directed 401k that got some money from rollover from somewhere else. So I could have done my 401k, but then I would have had to eventually pay tax on that $36,000. And I would also have to pay tax on the cash flow. This way I didn't have to pay tax on any of that, legally. So that was very good. Let's talk about some of the logistics. This is very important. People hear about the self-directed IRA, self-directed 401k, and say, oh, I'm going to do this, I'm going to do that. And you know, a lot of people, they flip, and when I hear a lot of people, when they do their flips, they say, you know what, I won't pay a painter, I can do the painting myself, I can do the plumbing myself, and I can save some money. You can't do any of that. You're not allowed to do any work that would be otherwise compensatable, if that's a word. Anyway, that you get compensation for. Like, I'm a licensed realtor. I don't list any of these properties. I don't list them. I have my broker. He does all that stuff. I'm not allowed to get any compensation whatsoever. I don't list properties. I don't sell properties. I just direct other people to do these things, because you're not allowed to do any work yourself. So, for example, this was a HUD home. Let's say that I was a wholesaler. And I hear a lot of people do this. Oh, they're wholesalers, and they say, well, you know what? I find all these really good deals, and every once in a while I'm going to take a deal and I'll flow it through my self-directed IRA or my self-directed Roth 401k or something like that. Well, if you're doing that marketing, you're sort of commingling your efforts from your non-IRA business or non-401k business with your 401k business. You're not supposed to do that. But you're allowed to identify opportunities. If you have a 401k at work, or you have a traditional IRA with Fidelity or Vanguard or whatever you might have, then you're allowed to choose, if you want to buy Nike stock, or you want to buy, you're allowed to pick stocks. I'm allowed to pick houses. Then you would direct your custodian for your traditional IRA to go buy Nike stock. I can direct the custodian, these days I still had a custodian, I could direct the custodian to go buy the property, which meant I would direct the custodian to send the money, to wire the money to the title company to buy the property. So the fact that it was a HUD home, I was able to identify that. It was right there on MLS, and it was purchased with the licensed broker, so I didn't do any work involved. I just chose the property. There was no marketing to sellers. So I was not, sending out, I did not put up "We Buy Houses" signs or anything like that. It was just straight, just bought it right off MLS. And 100% of the work was done by contractors. Now, even in my regular part-time real estate investing business, I don't do any work. I don't do any work. I don't change a light bulb. So for me, it was very easy. I didn't have to resist the temptation, oh, I can save money by painting. I don't paint. In those days, in 2014, I still had, even though I had a self-directed 401k where I did not need a custodian, I still had a custodian in those days. The first 7 years of my self-directed 401k, even though I had a lot of knowledge, I was not as bold as I should be until I got a lot more knowledge. So in those days, I still had a custodian, and here's what I did with the money. The custodian, I directed the custodian to send the money to the title company at purchase. So I didn't touch any of that money. Then I had a thing called a project manager. Now tonight we have somebody from the Wayne Kerr's office, and Wayne Kerr wrote the project management agreement for us in the first one. I think it was in 2010 that we did that. Wayne Kerr is a tax attorney, not just a attorney and not just a tax guy, but a tax attorney. So the contract, this project management contract, cites IRS code, IRC this and that, with those funny symbols. I don't even know what they look like two S's on top of each other. I knew it must be a very highly technical, valid contract, because when you start citing IRS code in a contract, that means basically Wayne was trying to prepare us for an audit. And as we'll see in a minute, I have a lot of best practices where I think that if audited, I'm in great shape. So in those days, I directed the custodian to send money to a project manager. This is not a property manager, it's a project manager. And what the project manager does, and did, is she would write every single check to every contractor, to the utilities, to the township, for the taxes, for Home Depot. She wrote all these checks. So I did not have to instruct the custodian to write a zillion checks. Usually there are between 30 and 50 checks on a rehab this size. And just every single time to have them write the checks is a problem. So what I did is I directed the custodian to send $30,000 to the project manager, and then later on another $10,000 just to be on the safe side, and then she wrote all the checks. She kept exact records in QuickBooks. Everything was reconciled down to the penny. So the records are perfect. All the invoices, all the records, everything is perfect. Everything matches up with the checks. Make photocopies of the checks, have a QuickBooks file, and a nice little package in an envelope. I did not touch any money. I did not touch any checks. I had a third party do this kind of stuff. This person was not an accountant. It was just somebody who I trusted. So that's from the logistics standpoint. Yes, there's paperwork and there's more to learn. And the question really is, what would you do for a Klondike bar? Okay, I had to learn a lot of stuff. I had to read a lot of stuff and learn, and there's a lot of compliance issues that you have to comply with. But here I made $36,500 tax-free. And if I would put it in my 401k, let's say I'm in the 28% tax bracket, another 6% for New Jersey, that would be 34%. So the question is, for this one property alone, if I would have done, eventually I would have had to have paid taxes on, it was a 34%, let's say a third of $36,000, that would be $12,000. So the question is, how much reading are you willing to do to save $12,000 one time? And the answer is, I'm willing to read. Again, I'm semi-literate, I got the reading comprehension skills, willing to do it. Here's a property that I just bought in my self-directed 401k on June 23rd. This house I bought in my self-directed 401k, not in the Roth, but in the 401k, and based on the guidelines in the video called How to Choose Houses for Rentals that you can listen to at parttimeinvestors.com. This was a short sale. Again, it was a short sale. It was listed on an MLS. I didn't do any marketing. I didn't do any work. It was a short sale listed on MLS. I told my broker that I want my self-directed 401k to put in an offer. He wrote up the offer. It got accepted, and everything was really nice. Purchase price was $110,000. It needed very light rehab. Most of what it needed was new air conditioning. But in the end, only $11,600, and the buy and hold costs were very, very short because there was hardly any time. It was 3 weeks before tenants moved in. It was very quick. So the total costs were about $123,000. The ARV is $160. So I had instant equity of $37,000. Do I really care about the instant equity? No, I don't really care. But it's always nice to know that when your net worth increases like that, it's actually pretty nice. There's a 4-bed, 1.5 bath, 1,695 square feet. So it's a nice size house, and it was a short sale. Because it's a rental, we have to look at what the rental numbers are, and the rental numbers are like this. There's no mortgage. Well, if there's no mortgage, then PITI. There's no PITI. It's just TI. So the taxes again are high, $481 a month. Insurance for this particular property, there was something special about it. It was high insurance, so it's $150 a month. Usually it's about $90 a month. So I have my tenant pay the $8 a month. It's $7.95 to be exact. Through Clear Now, it's an automatic withdrawal from the tenant's bank account, and it goes directly into the bank account of the self-directed 401k. So I don't touch any of this stuff. I don't even touch any checks or anything. It goes straight from their bank account to the bank account of the self-directed 401k. I'm not involved at all in this. The rent is $1,695 a month, and it's been going on now for 5 months. Everything is going like clockwork, just beautiful. Positive cash flow is $1,064, which meets my criteria because I like to have about $1,000 a month or more, if I can get it, of positive cash flow. Now, the cash-on-cash return is only 10.4%. I know you can do better than that with finance rentals, and we'll talk about that in a minute. But these are my goals. I'm 61 years old, and I have certain goals, and this meets my goals. The person that's renting this is a social worker, got four great kids. She's got a really great salary, and it's just a very good situation. I don't have to worry about her paying on time because it's automatic deduction, and I've seen her pay stubs. It's all very good. Logistics in this case. Okay, finally I was able to, after studying in tremendous detail, the do your own self-directed 401k offered by Camaplan. Finally, because I've been talking with Carl Fisher about this since 2009 when we met on the National RIA Cruise. Finally, after all these years, I finally set it up, and then I had a lot of questions for Carl. I really bugged Carl tremendously. And I set up the do your own self-directed 401k. So my fees are $300 a year. They provide the plan prototype, all 52 or 56 pages, and I've read every word of it. And actually I've read and I've reviewed it with Lou sitting in the back there so that we could figure out what we need to do with successor trustees and all kinds of other really cool things. I did none of the work. It was a short sale. Listed on MLS. Had my broker do the, purchase the property, do the purchasing process. 100% of the work is done by contractors. There was no marketing. But in this case, because I am the trustee, and like Carl said earlier, a self-directed 401k does not need a custodian. The trustee can be the trustee and the administrator, allowed to sign contracts, allowed to write checks. This is very different than an IRA LLC because this is a qualified plan. I'm the trustee of a qualified retirement plan, which is very different than being a custodian of a self-directed IRA. Or if you have a custodian of a self-directed IRA LLC, which I'm just a chemist, so I can't really say what the future is going to be. I'm guessing that a lot of self-directed IRA LLC people are making a lot of mistakes, and one day the IRS is going to challenge this, and if they do, maybe it'll win, maybe it won't win. But the trustee of a 401k, it's pretty much in the code. So as long as I am absolutely obsessive compulsive about compliance, and I am obsessive compulsive about compliance, I should be okay. So I have a bank account at TD Bank, actually, and I spoke with a number of banks, and the branch manager in Williamstown he just understood all the stuff straight away, which was just amazing to me. And we opened up the bank accounts. I have separate bank accounts from my Roth, my self-directed Roth 401k, and I have a separate bank account for my self-directed 401k. The QuickBooks, everything is totally separate. I do no commingling of funds between my 401k and my Roth 401k. Everything's got reconciliations, QuickBooks, everything is perfect. I don't want to get audited because it's a hassle and it'll cost money for my accountant, but other than that, I'm very confident that I will pass any audit. So as trustee, sent the money to the title company to purchase. I didn't touch the money. As trustee, I wrote the check directly from the self-directed 401k directly to the title company. Trustee paid all checks to contractors, utilities, Home Depot, and Township. I'm the trustee. I use QuickBooks. Everything is exact and everything's reconciled. And the rent is collected and deposited into the 401k by Clear Now. So I don't even have to deal with any of that stuff. It's very good. This is a property that I'm buying later this month, and this one's going to be in my self-directed Roth 401k, and we'll see in a second why I'm putting this in my Roth. The purchase price, this is a short sale. It's a 4-bedroom, 1.5 bath. This one's 1,548 square feet. It looks pretty similar to the house, the previous house, because the houses were built by the same builder. This is the subdivision across the street. This house is a little bit smaller than the other one, but it's still nice. This house has needs more than cosmetics. There's water damage and all this other kind of stuff. The contract we have it for right now is at 77.6. The short sale has been approved, so this is it's really good news. It's not theoretical, but that's the actual approved number. The rehab cost I estimate about $41,000, and the buy and hold cost I estimate about $5,400. It turns out that it comes out to a round number. I didn't plan it that way, but that's the way it came out. So the total investment I expect is going to be about $124,000. The ARV on this property is also about $160,000. So there should be instant equity of $36,000. Do I really care? I guess I don't, but in case the tenant decides to buy it later, this previous one where the rental, the one that I have right now in the self-directed 401k, the tenant said that when her credit is better in 3 or 4 years, she might buy the property. So if she does, but I might be able to realize how much, the $37,000 in equity, and that will go back into the 401k tax deferred, which will be nice. Tax per month on this one is $470. The insurance ought to be the normal $90 or $100. The Clear Now payment, because it's going to be the second one, is going to be $2. Who cares? The rent is going to be $1,650. The house is a bit smaller, but I'm pretty sure I can get $1,650 for this. And the positive cash flow is going to be $1,078 a month. Multiply that by 12, divide that by the $124,000, and we come up with a cash-on-cash return of 10.4%. Again, not great, but it's good. It's good it meets my criteria. The next couple of slides are modified from a presentation I made they'll be on the website soon, called Achieve Financial Freedom Through Successful Part-Time Real Estate Investing. And there are 2 metrics for financial freedom, and this is relevant. It's not enough to know the mechanics of self-directed IRAs and self-directed 401ks. It's important to know, why are we doing this? And the way that I see this is that there are two metrics for financial freedom. One of them is the cash, income or cash flow, and the other one is net worth or balance sheet. And in order to have true financial freedom, the way that I define financial freedom is when your passive income meets or exceeds your routine expenses, then you've achieved financial freedom. Financial viability is when your active income meets or exceeds your routine expenses. If you don't have that, actually, you've got a problem. But when your passive income equals or exceeds your routine expenses, that's when you have financial freedom, and also that your net worth is enough. The liquid part of your net worth is enough to handle all kinds of emergencies that you might have. So in this particular case, these are not my goals. My goals are actually higher than this, but that's okay. I want just to use round numbers. And now we're talking about people in retirement. I know a lot of the people here in your 30s and 40s, but you'd be surprised. Time does move exponentially faster as you get older. That's the way it works. Even though we all seem to be in the same universe, that's not really true. Things do move exponentially. So if you're in your 40s, age 59 and a half is just around the corner. Let's say somebody has a goal for passive income, for the passive part of their income of $10,000 a month, pre-tax. Then, if people are retiring and let's say they're 62 years old or higher, let's say you've got two spouses, one has 1,800 in Social Security payments, and the other will have about 1,200 Social Security payments, and let's say you've done some rental real estate, you got maybe 4 or 5 or 6 properties that are bringing in about $3,000 a month, and let's say you've got an LLC that's just regular funds, not self-directed funds, and you're still short another $4,000, fine, then have two free and clear rentals in your 401k, 2 free and clear rentals in your Roth 401k, and there you are. You got your $10,000. Now, in order to have your 401k open, you have to have a valid business. Another advantage, of course, is that the money that's in the self-directed Roth 401k, when you start distributing it, that money is coming out tax-free, where the stuff that's in your self-directed 401k, you have to pay taxes on that. So here are just some other thoughts about passive income and net worth. When I give the lectures on passive income and on rental real estate, normal rental real estate, usually we're looking for cash on cash return with financed properties of at least 15%, and 20% is better. 25% is almost impossible. It's not impossible, but it's hard to achieve 25% cash on cash return. But 15 to 20% is usually very achievable. And here I am at 10%, 11%. So these are not impressive numbers. If I were to take, this is important, if I were to take non-recourse loans, which I can do because it's a 401k, I can take non-recourse loans. I don't have to pay the unrelated debt-financed income tax, okay? The UDFI. Because it's a 401k, I don't have to pay the UDFI. So I could be financing these properties, and I can have more properties, and therefore higher cash-on-cash return and more overall income. I'm not sure if you all followed that, but it's important. Finance properties, typically you're going to get better cash-on-cash return than if you're using free and clear properties. But I'm at the stage of life, and if I've achieved my financial freedom, then I'm not necessarily looking for a lot more money. I'm looking for my time on cash return. If I have good properties with good tenants in them that are going to stick around for a long time, then there's just going to be less hassle. Now I'm not doing property management, but still to know that I like the more passive. Having it more passive is more important than having a higher cash on cash return. And 10% is not that bad. Let's understand people saying, "Oh, 10% return. I get on the stock market routinely." Yeah, the stock market is actually pretty risky because there are years that you do make 30%, and then there are years that you lose 40%. For those of you who remember the years from between 2000 and 2003, or 2008, from September 27th, I think was the date. For the next year and a half, those were tough times. But here, let's understand, the real estate over the long term, 10, 15 years, is appreciating. It's not losing value over long periods of time. So the underlying asset value is there, and you can even cash in on it, because if you're buying distressed real estate, remember, I'm buying at 40 to 45% of the property value typically, and then I'm putting in another 30% in repairs. So really what I'm doing is I have 30% equity. So that means in order for me to break even, the real estate price would have to drop 30% and stay there for 10, 15 years. It's probably not going to happen. Something that Carl said before, which is really important, is to try and do Roth conversions as early as possible. Right now, I'm looking at these different kind of permanent life insurance policies. I'm evaluating all that. I might try to make some money to pay the taxes to convert my 401k money and do Roth conversions to Roth 401k money, and then I don't have to worry about the taxes and estate planning, all this other kind of stuff. So that's pretty important, and that's why I'm now starting to buy rental properties in my self-directed Roth 401k. I think it's very important. What about flipping? Actually, is your name Ira? Wow, his name is Ira. He's got a sticker on his shirt and it says IRA. Oh, marvelous, isn't that great? Okay, so let's talk about flipping a little bit. This is a very complex subject. In the last few weeks, I've been reading a lot about this. Everything I've been reading, case law, everything I could possibly read. And remember, I'm a chemist, and I don't play an attorney on TV. So let's talk about flipping. This is going to get really technical, and I'm not going to talk about it too much, but I do want you to know that this stuff exists. There's a thing called unrelated business taxable income, and you have to pay tax on unrelated business taxable income if you're running a business in your self-directed retirement plan. There's this IRS code 512A-1 defines unrelated business taxable income as the gross income derived by an organization from any unrelated trade or business regularly carried on by it, less certain deductions. All right, that is actually sort of English, but the thing that we need to take a look at here, and there are three specific things. There's what is a trade or business, and what is regularly carried on by, and what does unrelated mean. We won't go into all that, but I do want to talk about this regularly carried on by. And I've actually read a bunch of case laws with Police Benevolent Association cases and all kinds of other stuff. It turns out, and again, this is going to be even smaller print, and I'm not going to read the whole thing, but basically part of what it says here is that the business is regularly carried on. Let's say you have a flipping business, and some of you here in the room are active real estate investors and you flip. And let's say you flip 4 or 5 properties a year and you make $25,000 in each one, so you got $100,000 to $125,000 of income, and then here comes somebody who wants to flip a property, doesn't have to pay any taxes because in their self-directed 401k, self-directed Roth 401k, that would give me an unfair advantage. Or let's say somebody is doing 4 of these a year and says, you know what, the fifth flip, we'll put in a Roth, and then we'll save all this money. Well, you can't do that because that's an unfair advantage, and because you are engaging in a business that regularly carried on. So if you have a flipping business, that you're regularly carrying on, you just can't have one that has a flip in it.
Just correct you on that. You can do it, but you have to pay tax.
Very good, Carl. Thank you very much. That's right. What Carl's saying is that you can do these flips if they're not disallowed, but you'd have to pay the 39.6% tax or whatever the tax bracket is going to be as taxes do go, because taxes are going higher. There's no question about that. And but if you're doing a business discontinuously or periodically, like once a year or something like that, this may or may not fall under the IRS code. I am a chemist. I am not licensed financial advisor or anything like that, so I cannot tell you that you can do this. And it says in red letters, I'll read this out loud, consult with a licensed accounting professional to determine if UBIT rules apply.
Yeah, but Mark, when we say if it's periodical, it's also regularly.
It's not. And but again, I'm just a chemist and I don't want to cite it, but for example, if you have a seasonal business that's open for 4 months out of the year, it's discontinuous. Yeah. So then the question is, what are we allowed to do or not? And the answer is, I don't know if flipping is allowed, but I do it from time to time. And I'm not recommending that you do it. And I also say that every case is different. So a while back, I thought about it, and I'm asking the following what-if question. I don't have an answer to it, but I'm saying, what if? What if your self-directed 401k holds mostly rentals, because rentals is not considered a bit, it's passive income, and especially even if it's financed in a 401k, you're okay, and mine are free and clear. So if I've got free and clear rentals in my 401k that's passive, that's not considered the kind of business that would be subject to the UBIT. So what if mostly what I have is rentals and other passive investments like private lending and stuff like that, and all my activities are fully compliant because QuickBooks and segregation of funds and everything is absolutely perfect. I do no work, I can document everything. And then I do a flip from time to time, like maybe once a year. And some years, because I've been averaging less than once a year. Okay? In that case, what would is the IRS likely to challenge me? And it's in a 401k. The answer is I don't know. And if they do challenge me, will I win? The answer is I don't know. But I'm playing the probability that if I have mostly rental real estate in my self-directed 401k and Roth 401k and other passive investments, my documentation is as good as it possibly can be. And then from time to time, I discontinuously do a flip from here and there, especially if my intent is to rent, like the one I had in Railroad Ave. My intent was to flip. I have documentation that shows I have a rental application, and I actually have a lease that was written, and then he comes to me and he says, let's buy the property. If the intent was to rent, then would it be okay? And right now I'm taking the chance that it is. So here's, I did one flip in 2012. It was a partnership, 50% to my self-directed 401k and 50% to my self-directed Roth 401k. Sold it for $170,000. Purchase price was $95,000. Repairs were $26,000. Buying costs, holding costs, selling costs. You see what you see there. And I made $37,000. Half of the money went into the Roth 401k, and half of the money went into the self-directed 401k. That was a 3-bedroom, 1-bath, 1522 square feet. Bought it from a wholesaler. So again, I didn't do any marketing, and I didn't do any work myself. I never do work myself. If you don't believe me, ask my wife. I do nothing. She takes no interest in any of this, except she likes to see what the balance sheet looks. She likes to look at our personal financial statement every once in a while. And then here's one which I did in 2015. This was done on my self-directed Roth 401k. Bought the house at auction. It was actually an REO, and it was at auction, and it was bought it for my self-directed Roth 401k. Bought it for $76,125. The repairs were, it was a significant project. It was $43,800. Buying costs, holding costs, selling costs, and this thing sold in less than 2 months because there was somebody that liked the neighborhood, saw basically another house that I was doing, and said, yeah, they really like this one. They happen to be a cash buyer. They actually broke their 401k. They're about my age, and they broke their 401k and paid cash for it. So there was no appraisals or anything. It was a beautifully done home, and the costs were very, very low. This was an REO. It was from Wells Fargo. And so again, it was listed on MLS. There was no marketing on my part, so it was very good. And this was in my Roth, and it added $48,000 to my Roth. You see why these things are growing? So is flipping okay? Well, the answer is it depends, and I can't even tell you what it depends. So all I'm going to do is I'm going to read this disclaimer again. Consult with a licensed accounting professional to determine if your circumstances allow flipping in your self-directed retirement plan, whether it's a self-directed IRA or 401k, and if so, does the UBIT rules apply? And of course, if you have a self-directed IRA or self-directed Roth IRA, and you have financing, you'll also have the unrelated debt-financed income. So to summarize, and I'm trying to sort of put in what Carl said and what I said together. The self-directed 401ks and self-directed IRAs, they have advantages and disadvantages. Some of the advantages that I see are for the 401k, the Roth contribution limits are much higher. You can ramp up your retirement contributions very quickly. You can take non-recourse financing, not subject to the UDFI. And you can have checkbook control that's not likely to be an issue. Whereas I think with the self-directed IRA LLCs, they may be an issue. But what do I know? I'm a chemist. I'm not an attorney. I'm not an accountant, so I don't really know. Just what I've read. The advantage of self-directed IRAs is that you have self-employment. Self-employment is not required, like it is in a self-directed 401k. And of course, the self-directed IRA, another advantage is that you don't have to take federal tax withholding when you take your distributions. And just to let you know, some of the other lectures that are on parttimeinvestors.com, either now or in the next few weeks, are 10 Essentials for Successful Flipping, How to Choose Single-Family Homes for Rentals, Achieve Financial Freedom Through Successful Part-Time Real Estate Investing. This is for those of you who are landlords. There's one here, How to Establish Acceptable Standards of Behavior for Tenants, Tenant Buyers, Other People's Children, and Other Humanoid Life Forms. And that one's about half psychology and half best practices for screening tenants. Wholesaling from the buyer's perspective, and an interesting one, which I've really never heard before, leverage of OPM, the good, the bad, and the ugly in real estate investing. And because people are always saying, the more leverage, the better, and I don't believe that's true. So with that, that's pretty much what I had to say, and I'll take questions. But first, again, I want to thank Carl for the outstanding presentation on the mechanics. This is really the first time that I've heard anybody talk about the difference between self-directed 401ks and self-directed IRAs. People barely know what they need to know about the self-directed IRAs themselves. And I think I heard earlier that the number of self-directed 401ks that are out there are probably about 5% of the number of self-directed IRAs that are out there. There really are advantages, but you have to be compliant. And I'm one of those, obsessive compulsive people that I think it's good. I'm not saying I do everything right, but I really try hard, and that's good. So thank you very much. And if you have any questions, I'll be glad to take them.